Hello students and welcome to the lecture. So students, as we know that we are covering the financial system and basically what we have started the foreign investment in it. Okay. And in the foreign investments, basically these are the topics we have scheduled for the discussion. Like you could say that we will discuss about the foreign direct investments, foreign institutional investments, and the foreign portfolio investments. Okay. So these are the topics we are supposed to discuss. Right now, we have been discussing the foreign direct investments for last few lectures, and the topics we are left with are the foreign institutional investments and the foreign portfolio investments. Okay, so that is the scenario. So basically in this lecture we are going to start from where we had left in the previous lecture. Okay, so you can say that after completed the trends, now we are going to start with the role and the implications of FDI in India, like what the role they had played and what are the implications of their role in the Indian perspective. So here it is FDI as a source of money for India's economic development. Foreign direct investments, FDI plays a crucial role in India's economic development by providing a significant source of capital. When foreign companies invest in Indian businesses, they bring in funds that can be used for the various purposes such as expanding operations, upgrading technology, and creating the new infrastructure. So basically, if we talk about it, then always remember that the foreign investments, and if we talk about the FDI in particular, then this is usually done in the form of international currency. Okay, and what is the international currency? I had told you in the previous lectures also. So the international currency is United States dollars, right? Also known as USD. Okay, so the general, you can see the FDI in India are generally made into the US dollars. Okay, and that's bring a huge capital intake. Why? Due to the conversion rates. Due to the conversion rate, the you can say the huge capital intake is there. For example, suppose if we talk about the today's conversion rate, then 83 rupees is equal to 1 US dollars, right? This is the current scenario. So basically, if we go by this, so suppose here is rupees 15,000. That is the funding we had raised. But here is USD 15,000 which have been invested. So if you convert this USD into rupees, then it will be stand nearly about 12 lakh and the 45,000. So can you see the difference? Like 15,000 rupees and $50,000. How much is the difference? Right? That is what here. Like the FDI or the foreign investments, if they are making into the US dollars or the international currency, basically they are bringing the huge chunk of the capital into the market. All right. And this capital could be used for various purposes like expanding operations, upgrading technology, and creating a new infrastructure. Okay. So that's why FDI is important. The influence of capital not only stimulates economic growth, but also helps in creation of job and overall development of the country. All right. Thereafter, now we have foreign companies investing in the fast growing private businesses in India. What does it mean? Foreign companies often invest in the fast growing private businesses in India to capitalize on the country's dynamic business environment and relatively lower wage cost compared to the developed countries. Okay. By investing in these businesses, foreign companies can benefit from the growth potential of the Indian market and gain access to a large consumer base. Now come to the previous slide. Here are certain things which we are required to find out. So if we recall the previous lectures which we had discussed, okay, so there was one thing which I had told you. And what was that thing? That there are two ways for acquiring the, you can say, venture in India through FDI. First, establishing a totally new venture. It's the first case. Second is invest in already existed venture. Okay, so there are two ways. Okay, so if we look at here, then what is written down here? That the fast growing private businesses in India. So if we just analyze the wording, what we are getting, that the businesses are already existed in India. Got it? So basically what companies does, suppose if this is an XYZ and this is an foreign entity. All right. And this is ABC. And what is this? It is a domestic company. Okay, there are two cases. So what is happening? That the XYZ is making the investment in the ABC. And you can say bringing the capital influx into the ABC. So what are the benefits the XYZ will be titled to? Because the ABC is already, you can say, established in India. Okay, so that's why they are not supposed to go through the establishment process. Secondly, if ABC is doing business in India, then must be they having the consumer base, which will be directly beneficial for the XYZ. All right. And the third is that less risk. Why? Why is there less risk? So to understand, just take an example. Suppose this is you, this is your friend. Okay, your friend has opened a food restaurant. Okay, you also want to be the part of that food restaurant. So what you did, that you make the investment in the food restaurant. Okay, but after some time, due to something, the food restaurant has to be closed. Okay, so what will happen? That your investment will be lower in comparison with your friend. Why? Because that the person who has to, you can say, purchase a land or rented the land, then go through the various processes. His time will be consumed there. Then he has to make the infrastructure for the food. You are just providing the money so that you could be the partner of it. Okay. So if we make it in a technically, then suppose you have invested rupees 8 lakh, your friend has invested rupees 2 lakhs. So what is happening? That when the business will be wind up, your investments relatively low in comparison with your friend. Similar thing happens here. Like the ABC has to invest much in comparison with the XYZ. Why? Because the XYZ is basically investing into the international currency. Okay. So that's why they are bearing less in comparison with themselves. But the ABC, which has established the business in India, basically they are investing more time, efforts, and money in comparison with the XYZ. So that's provide a safe zone. Okay. So this is the first reason why they invest in the fast growing private businesses, because their risk will be low and their chances for growth will be high. Thereafter, lower wage cost. All right. Always remember that in India, labor cost is comparatively low than the developed countries. Okay. And even you can say that the labor laws are not as much stringent as in developed countries. Okay, labor laws are not as much stringent as in developed countries. So that is the benefit of it. Got it? Thereafter, by investing in these businesses, foreign companies can benefit from the growth potential of the Indian market and gain access to the large consumer base. Why? Because if XYZ invested into the ABC, then the ABC will invest into the Indian market. Okay, but the return of it will come to the ABC and then the XYZ. So you could say that XYZ will have the access to the Indian market through the safeguard of ABC, right? Thereafter, next is economic liberalization and rise in FDI activities. Okay, so if we talk about it, India embarked on a path of the economic liberalization in 1991 in response to a severe economic crisis. Okay, like we can say that from 1949 onwards, there was a trend in India for the nationalization. Okay, and you can say welfare approach or some kind of socialism, right? From 1949 onwards, that was the thing. And basically, due to this, what happened that in 1991, India has to brought the new economic policy because the things were not in our favor. Okay, our economy was not doing well. Okay, job market is totally collapsed. All right, so to overcome this kind of situation, basically the new economic policy was brought to the market, and due to this, three main principles were introduced. LPG. Okay, liberalization, privatization, globalization. Okay, liberalization, privatization, and the globalization. These are the three basic principles of the new economic policies, which was introduced in the 1991. And the question is that who had introduced these principles? Who was the one who formulated the new economic policy? Come on, I'm providing you 20 seconds, then I will give you the answer. So your time starts now. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13th, 14th, 15th, 16th, 17th, 18th, 19th, 20th. So the correct answer is Dr. Manmohan Singh was the person who has formulated the new economic policy, and he was our ex-finance minister and ex-PM. Got it? So keep this thing in your mind. This period marked a significant shift in India's economic policies with reforms aimed at opening up the economy, deregulating markets, and attracting the foreign investments. So basically, what was happening? That due to, or you can say prior to the 1991, due to the welfare approach, okay, what the government was trying that to flourish local businesses only. Okay, due to this, that the Indian government was not allowing the outsiders to come into India and participate into the Indian economy. Okay, to safeguard the local businesses and let them flourish. But Our economic conditions were not so good on that time and we were suffering a lot. Okay, so that's why what was happening, that in the 1991 the government has decided to opening up the economy. It means that the market was deregulated and the foreign investors were allowed to establish ventures, make investments, and partnerships in India. Okay, so basically, the foreign investors were getting permission to establish the new ventures, make the investments and partnerships in India. Okay, that is the thing. All right. Since then, FDI activities in India have been on the rise, driven by the government's efforts to create a more investors-friendly environment. Like you can say that the 1991 provisions helped us a lot. Okay, and India had seen that the FDI having a huge growth potential in comparison with the other type of investments. Because as I have told you, like the normal investments which are made in our country are you can say generating the same capital. But when they are making in the US dollars or the international currencies, basically they are generating the huge capital. Okay, so that was the beneficial part for us. All right. Thereafter, next is generating employment opportunities. One of the key benefits of FDI in India is the creation of employment opportunities. When the foreign companies invest in Indian businesses, they not only bring in capital but also create job for the local workforce. Okay, because whenever the company will expand the business, for example, suppose if this is a you can see the restaurant XYZ which having its branch at Karol Bagh, Delhi. Okay, now the business has been funding by some foreign entity and now they want to open their branches in Pritampura. All right, thereafter you can say Rajiv Chowk. Okay, you can say the other places of Delhi. Okay, like Hoj Khas and all. Okay, so if they are doing this kind of thing, so what do you mean? Like what will happen here? If they are expanding their branches, then they will also employ people there, right? Because without people, the business could not be sustained or could not be done, right? That is the reason that, or not only the business is expanding, but also the locals will getting the job. All right. This is This is particularly beneficial in sectors such as the manufacturing, services, and the infrastructure, where FDI can have a significant impact on employment generation. Okay. So after finishing the trends, now we have the roots of FDI in India. Okay. So basically, first route is the automatic route. So what do you mean by this? Under the automatic route, the FDI is allowed without prior approval by the government or the Reserve Bank of India. This means that the foreign investors can invest in sectors permitted under the automatic route without the need for any government approval. The process is relatively simpler and faster compared to the government route. Like you can say that in India, while you can say promoting the policies of the FDI, we had selected the automatic route for subsectors. Like you can say, suppose if there are 5 sectors, 6, 7, 8, 9, 10, and 10 other sectors. Okay, so the government has decided that this one, this one, this one, this one, and this one. So the blue sectors are the automatic sectors. Okay, so you could say, suppose if this is a company XYZ, which is a foreign entity. Got it? The XYZ is a foreign entity, for example. Now, if the XYZ is deciding to make the investment in India, so they have got the government route and the automatic route. Okay. So if they are making the investments into the automatic sectors, all right. So basically, they are not required to obtain permission, no approvals, and no permissions are required. Okay. So that's why the process is easy and fast. Okay. Because no paperwork, no formalities, no other kind of stuff is there while doing this kind of things. Okay. So now the question is that what are the permitted sectors under the automatic route? This is the main question. Most sectors in India allow FDI under the automatic route subject to the prescribed sectoral caps and the conditions. These sectors include manufacturing, services, infrastructure, technology, and among others. So basically, students, I will show you the proper table for both the automatic route and the government route. Okay, I will show you the proper table for both. But till then, you are just required to understand the meaning of them. Like what is the meaning of automatic route? What is the meaning of government route? Got it? And here is also the sectoral caps. What is the meaning of sectoral caps? So basically, you can say that the government has prescribed a limit. Okay. However, there is no permission required or no approval required for making the investments in the case of automatic routes. But the condition is that there is a fixed or the certain limit up to which the investments could be made. If the investment is crossing that particular limit, the investment will not be carried out forward. Okay. And then the government machinery may be interfere. Thereafter, the reporting requirement. Even though prior approval is not required, foreign investors are required to notify the RBI within a specific time frame after the investment is made. This notification is for record keeping and monitoring purpose. For example, suppose the RBI decided that within 3 months of investments, the RBI must be notified about the investment type, okay, purpose, and you can say about the quantity, like how much quantity the investment has been made. Okay, so you could say, suppose if this is a foreign entity XYZ, okay, and they had made an investment into the domestic company by using the automatic route. So while making the investment, they are not required to obtain the permission. Okay, but suppose if the investment was made into the month of January. So if we calculate the 3 months, it means that January to March. Right? January to March will be there. Got it? All right. So what is happened? That if the XYZ and the domestic company fails to notify the RBI about the investment within this specific time period, then what will happen? The strict action could be taken against the both, because then they both will be the violators of the law. Okay, so keep this thing in your mind. All right. So students, basically in this lecture we have finished till here. In the next lecture we will continue from here. Till then, just revise all the facts and figures we had discussed in this lecture. Be ready for the another lecture. With this note, let's end this lecture, and what we say thank you.